Apologies for the slow start. I forgot to press start broadcast, so you should all be hearing me loud and clear now. This week, we'll be looking at some key economic data points and making sure that we're clued up to the major drivers that we're seeing in markets at the moment. It is Fed policy and how the market responds to Fed policy. So we're going to make sure that we're 100% up to speed with that story. That will clue us into what the dollar's doing. We're also going to look at the yen with Tokyo inflation data coming out overnight, and we'll see how that impacts the yen itself, as well as looking at stocks and equities as we try to get a handle of what's going on. Markets have started on a risk-on positive footing, more positive news out of China. There seems to be a bit of a pullback from the crackdown that we saw on the tech sector, as well as support for the economy and the property sector, as well as the opening of China's borders. There's more free-flowing traffic now between Hong Kong and China, and the general kind of pullback from strict COVID curves, which we saw at the end of last year, are being pulled back more and more and more. So that's just helped lift sentiment this morning. What we're going to be looking at today, I'm going to get us straight into the topic because I want us to know exactly what's going on, so we understand exactly the market sentiment. Now, I want to take us back to last week, and if you remember last week, we were seeing some dollar strength come into the market after we saw some pretty firm data points until we got to Friday. Now, if you just take a look at the dollar, because the dollar was gaining quite strongly.
It's just as we see some US players arrive all the day
into Friday last week. And we saw the dollar gain up to that sort of 105.50-ish region, depending on where your feed is in the dollar index. And then we saw the dollar sell off sharply. Now, I just want to explain why the dollar sold off sharply and why that's going to be important for this week. It was all to do with this slowing print that we saw on Friday. Now, non-farm payrolls was pretty strong. We saw the headline at 223,000, just above the forecast. Unemployment rate was below expectations of 3.7% and in line with the low expectations of 3.5% positive. And the non-farm private data was 220,000 above 180,000 expected, and the participation rate was higher too. So a good print in as far as those elements went. Now, average weekly hours were a little bit lower, but the prior was revised. The prior was 34.4, and the average hourly earnings, the month-on-month prior was revised lower to 0.4%, revised down from 0.6%. So that provided a little bit of relief on the strong average weekly hours we'd seen in previous months. So on balance, that was reassuring. But then it was this data point here that markets really reacted to. We had a bit of a sell the rumor by the fact response, because we'd had good ADP jobs number in the week and expectations were rising for a good jobs number. So okay, we've got a good number, but no big surprises. Buy the rumor, sell the fact response expected. But then that sell-off really added to the initial buy the rumor, sell the fact response with this print here. It was the US ISM non-factoring PMI. This is the services print. You see how on aggregate it's a miss, and business activity below the low expected, and the headline below the low that it was expected. Factory orders low, and all of this shows that the US economy is starting to show signs of slowing down. So in the big picture of things, this means that the Federal Reserve was being anticipated by the market to have a slower path of interest rates going forward. Now, if you just take a look here at the short-term interest rate market's expectation, and this is on the Financial Source Sterling Market Projector tool, which is an excellent tool that I use every day. And what we can see in short-term interest rate markets is that investors are now expecting the Federal Reserve to cut by 50 basis points in the second half of this year. But the Federal Reserve itself is only expecting according to its minutes, no rate cut expectations at all. So the Fed's saying we're not going to cut rates at all. The market's saying you're going to cut it twice this year. So that's why when we had that very weak print here, the market then said, aha, see, Fed, you will have to cut interest rates. Why? Because growth is slowing. Now, don't misunderstand this. This is not saying that this narrative is now set in stone. But what it is saying is this narrative will be questioned, pushed, pulled, tested on every single data point that's coming up. So that means this week, the most important data point is going to be the inflation data out of the US on Thursday and the speech from Jerome Powell on Tuesday. So if you think about it, if you were in the Federal Reserve and you've seen the market reacting this way, you've suddenly seen the dollar selling off, equity market starting to pump higher. Why? Because investors are expecting a lower path of interest rates, which is a more conducive environment for equities. So that's why we're seeing equity markets push higher across the US futures and German and European stocks and FTSE 100 stocks seeing some relief as well on that general narrative. But China 50 is pushing up for slightly different reasons, but it is still buoyed along with the more positive sentiment. So then you see on Tuesday, Jerome Powell seeing this, and well, the last thing he wants to see is the market pricing in, rate cuts when the Federal Reserve has said explicitly they don't expect any rate cuts now until 2023. So watch out for what Fed Chair Powell says on Tuesday. See, he could turn around and say, we are adamant at bringing inflation down. And if you just take a look at the global inflation rates, you can see that the US inflation headline at 7.1%. No, it's not, the inflation is not as high as it could be. It's obviously not up to Turkey and Argentina's levels. You wouldn't expect that. But you've got UK, Italy, Russia over 10%. All of the nations are below 10%. And you've also got countries like China, Switzerland, Saudi, Japan with very low inflation. So the US is right in the middle, but remember their target's 2%. So if their headline target is 2%, 7.1% is still 3 times what they're expecting. So that means that Jerome Powell very easily could say something that really hits that dollar weakness. So watch out on Tuesday. There could be an opportunity to buy the dollar on Tuesday. Now, the best way of looking at that would be looking at a short euro-US dollar option. So the way I would be looking at playing that, I would just be ready, looking out for Powell's speech. And then if we get Powell's speech, what I'd be looking for there, it will be shorting and then stops above the relevant pivot point and then looking to take profit at the next pivot point. So it could only be sort of 10, 15, 20 point move, but it is one worth looking at for next week. And the best potential would be if Jerome Powell says something very hawkish. So if he says something like, we don't agree with the market's pricing of rate cuts this year, or we're going to be firmer than the market's expecting, or anything that sort of pushes back against that sort of bearish market expectation that's being priced into short-term interest rate markets. Then on Thursday, this will be the best economic data point for the week. I will cover this on Wednesday. So do come back on Wednesday and check out the economic data point session that I'll be doing specifically on the inflation rate. Now, you can see that the headline is expected to come in at 6.5%, down from the prior of 7.1%, and the core inflation expected to come at 5.7%, down from the core 6%. So in other words, investors are expecting a lower inflationary pressure, so that should be dollar negative into Thursday. So depending on what Powell says, we would expect to see the dollar weakening into Thursday potentially, because why? The market's expecting a lower reading. 7.1 to fall to 6.5, 6% to fall to 5.7 for the core. So lower readings should allow the dollar to be sold depending on what Jerome Powell says. But then when we get the decision, what we need to see is a move that contradicts the latest move. Now, the latest move we've seen there's a lot of dollar weakness, isn't it? So the best opportunity would come here from a very high print. When I say a high print, anything above 7% for the headline and anything above 5.9% for the core will be higher than the market's highest expectation. And think about it, that will play into the Fed's narrative of no rate cuts this year. So that would allow the dollar to strengthen. So the best opportunity at the moment would come from a very strong print. And then we could also potentially look at shorting equity markets as well. So in a situation like that, you'd expect to see S&P 500 fall down, NASDAQ fall. So you could potentially also look at selling those markets as well on a very strong inflation print. And also just keep an eye on this kind of, condensing price action around here. And you see this very large bearish engulfing bar. There's going to be some big sellers up around that 4,000 region. So, a retest up to this trend line. Now just move that trend line out now, and just means a retest up to 4,000. You would expect to find sellers up there. So, obvious place for sellers at 4,000. If price moves up to that region and then, get another test of this trend line, then that's a very easy place to define a limit risk. And a high inflationary print would be a great trigger. So look out for that on Thursday. So we've got dollar opportunities this week. Now, other major events to look for. I just want to go to Gavin's question. Gavin's got a question. Thank you, Gavin. Gavin asks, with China's reopening theme, is there a possible swing trade for something like the Aussie CAD? Thank you very much. Now, interestingly, the Australian dollar is being boosted by the reopening theme in China alongside the New Zealand dollar. You can see in terms of strong currencies today, the Australian dollar is the strongest. We can see that the dollar remains the weakest alongside the yen. Now, the CAD is also fairly strong, up alongside the New Zealand dollar, the Aussie dollar. So we're seeing a more risk-on tone. We're seeing equity markets higher. Bond yields are a little bit lower today, which is more risk positive in today's environment. We've also got the major commodity currencies broadly higher and safe haven currencies broadly lower, dollar, yen, Swiss franc and CAD sort of pretty much slam bang in the middle. So in terms of a good opportunity for a possible swing trade on the reopening theme, Aussie dollar strength makes sense, particularly with that new the Aussie dollar makes sense, particularly with the news that China is reversing or looking at reversing some of its ban on Australian coal imports. So that's good news for the Australian dollar. Just to think which currency pair to trade it with on a swing trade basis. Just trying to think on a swing trade. CAD could benefit from a pickup in oil, which is what's making me a bit nervous about the CAD. You can see that oil markets are also picking up on that reopening theme, and oil markets really do mirror the CAD quite closely. If we just take a look at the Canadian dollar as an index and sort of overlay oil markets onto it, what you can see is that, falling oil, falling CAD, rising oil, the pressure is on the CAD to rise as well. So Aussie CAD the CAD and the Australian dollar could both benefit from the reopening theme. I think what I would potentially like on a Aussie US dollar is if we saw a big reason for US dollar weakness come into the market this week, that could open up a potential opportunity, but then the US dollar is quite heavily sold. So in terms of a swing trade, I'd have to think some more, Gavin. If you could, give me a heads up while you're thinking of the CAD, because I know you're a canny fish yourself, and you've obviously given this some thought. So if you just give me some heads up on the CAD, it may be that I'm just not up to speed with the CAD right now, and you're more up to speed with it, which obviously, you know, it's hard to stay on top of every different instrument. So just, I'll wait to see if you're saying about the CAD. Otherwise, but the Australian dollar finding some residual strength on reopening theme, yes, definitely, I do see that. And even like some tech stocks like Alibaba from the China reopening theme, I think that's quite nice. Also notice China's 50s trying to push above this potential trend line. So if you just look at this, that is a potential buy at market with stops just underneath that 12,800 level, which would be a swing trade opportunity on the reopening theme. You see, you got 1, 2, 3, break, close above on the reopening theme. So just sort of buying at market with stops underneath 12,800 would make sense, and then potentially look at taking profit at, you know, 14,000, maybe even up to 14,500. So that's what I'd probably look at on the reopening theme. The swing trade is like a China 50, depending on the cost you have for trading the China 50 index. So that's my initial reaction on that, but I could be missing something with the CAD. In terms of the rest of the week, key data points to look for is this Japanese inflation data coming out tonight. Now, the Bank of Japan surprised markets at the end of last year with this shift. They have shifted the yield curve from that 0.25% cap up to 0.50%. And expectations are rising that in April's meeting, the Bank of Japan is going to change from their very loose monetary policy and maybe hike interest rates. Now, a couple of things to say. The Japanese CPI print is due later and can give a good indication of CPI throughout the rest of Japan. If you just take a look here at the CPI print for Japan, it's supposed to be 3.8% was 3.8% in November, so it's been rising. It's a sort of a 40-year high, Japanese inflation. And even though the inflation is on a global level is quite low, you can see it here, 3.8. It's only lower, beaten by Saudi, Switzerland, China. So it's one of the lowest countries for inflation. This is still very high by Japanese standards. So it's raising expectations that Japan will hike interest rates. And when you look at Japan's interest rate level, you see, look, they are at 0%. So when you compare that to minus 0.10%, when you compare that to other central banks, 4.25 for the Bank of Canada, 3.5 for the Bank of England, 4.375 for the Fed, etc. So you can see that the Bank of Japan has very, very low interest rates. So if the inflation level surges, expectations are there'll be more yen strength. So watch out for that. Now, I also saw a report that Japan have said, the Bank of Japan have said that just because you get some, inflation revised higher doesn't mean they're automatically going to hike. They're going to focus on something they call the super core. So I'm not exactly sure what the super core is. I think it may be as the core. So I have to do a little bit more digging on that. But it tells you that if this goes a bit higher, they're not automatically going to hike interest rates, but it is certainly worth looking at. And particularly if you look at the dollar yen. Now, the dollar yen, and we just want to look at this on a wider time frame. You can see that the dollar yen, the yen was very weak all of last year, and we're starting to see some of that yen strength come back in. Now, if we get more reason for dollar weakness, so if the Fed starts showing that they're going to be changing their mind, we could potentially see some more dollar yen downside. But this looks very, very heavily sold to me. So the best opportunity I would like is that if we had an inflationary miss, and then we had a hawkish Powell tomorrow, that would set up a nice little swing trade for a couple of days. So we'd need to see Japan's inflationary data missing and coming in well below market expectations. And then we'd also need to see Powell tomorrow being more hawkish, and then we can see some of this dollar weakness and yen strength unwind, and we could get a pop back up to 134, maybe even to 135. And if 135 broke, we could look at a move up to 136. That's typically what I'd be expecting, but I would need to see the economic data point confirm that. So that would be a miss in the Tokyo CPI print. So if it came in below the prior, if the core came in, 3.5%, and the headline CPI came in below, 3.6%, 3.7%, something like that, that would just reassure markets that the Bank of Japan isn't going to instantly hike interest rates necessarily in April. But on the other hand, if we did see very high interest rates, then do look out. If we saw very high interest rates, do look out, high inflation print rather, do look out for yen weakness. But the yen has shown yen strength, but the yen has shown quite a lot of yen strength. Sorry, I will get my head straight in a minute. If you just take a look at the basket of currencies, you can see that the yen weakness from last year is being unwound, okay? And it's being unwound on the expectations that the Bank of Japan may be more hawkish in their April meeting. So a very high print, we might see some more yen strength, but I wouldn't be interested in chasing that because quite a lot of that move has already happened. I'll be most interested if this is a miss, and then the Fed is more hawkish, then I'd quite like some dollar yen longs. On Wednesday, there isn't anything particularly that's getting my interest. We have some EIA crude stock levels, and that could also impact crude markets, but I'm preferring to play the bigger picture on crude at the moment rather than these short-term moves. Chinese inflation data, very low. That's printing on Thursday, not expecting anything. Core inflation print is the main event of the day. And then Friday, we've got quite a slow end of the day Friday, but end of the week. But the Michigan consumer sentiment data is worth looking at. Now, there are inflation expectations in this US Michigan data prints. And the 5-year inflation expectations are important. If that sort of comes in, 3 or 3.1%, then that will show them the Fed that they need to be more aggressive to bring down inflation expectations. Remember, their target's 2%. So the last thing they want to see is inflation expectations for nearly 3% for the next in the next 5 years, right? They want to see that coming down. So that comes down 2.7%, 2.6%, big tick. Because what that means, the Fed's policy is working, and then we can see some more dollar weakness out of that. Consumer sentiment would be important, and some analysts prefer this data point as a very good indicator for a US recession, because the US consumer is more sensitive to market conditions change in some ways than a US business. US business, they make decisions maybe 3, 4, 6 months, 12 months at a time, so they can be slower to react. But consumers, when they're asked, about their spending, if they're feeling the pinch, that they're going to adjust their spending that month, right? So they're very responsive. So if this comes in below 57.4, then we could see some more dollar weakness. So remember, don't be surprised if we see the Powell speech send the dollar one way, inflation data send it the other, and then the Michigan consumer confidence send it the other. So what I'm doing at the moment is I'm trading these short-term deviations. I traded dollar long into last week, closed it out before the NFP, and then I traded equities long out of Friday last week, and I've closed my profit there. And now I'm looking at what's going to happen on Tuesday, and I'm going to potentially take another short-term trade there, depending on what Powell's saying, and then I'll quickly close out, and then I'll be waiting and holding till Thursday. Do you see the way that I'm handling it at the moment? Little short chunks, not trying to guess big picture stuff. Right, Gavin, thank you very much, Gavin. That's very good. Right, so this is Gavin's logic for the Aussie CAD. But what Gavin points out helpfully is that the CAD failed to rally on the positive jobs data on Friday. Yes, very positive jobs data. You would expect to see some underlying CAD strength. They're both high beta currencies, so wouldn't suffer too much in swings, risk on and risk off, and are both affected similarly. Yes, so what Gavin's saying is by pairing the Aussie dollar and the Canadian dollar, he can hopefully take advantage of the difference in outlook between the Aussie and the CAD, but if risk sentiment suddenly turns off or on, they both should be impacted relatively equally. Gavin says, I don't think it's necessarily in a good position now, but I wondered if it is a theme it might work. Thanks. Yeah, okay, Gavin, I can see your logic. I knew your logic would be there, and it's sound logic. Let's just look at the CAD and a basket to see where we're at in terms of the overall index. CAD has been seeing, yeah, see, the thing with CAD is around the sort of, the end of last year, I was sort of quite confident on looking for a bit of pullback in the CAD. Okay, so we've seen that pullback now, and markets are sort of pulled back, but we didn't see much CAD upside on that positive jobs data point. But if we just look at this on a daily chart, what we can still see is a little bit of a sitting above that potential trend line. So for an intraday trade, you know what I mean, the Aussie CAD, maybe try and sneak something on Monday, it would have been okay. For a swing trade, I don't like it because the jobs, because the CAD is quite heavily sold. Would I expect a potential pop retracement here anyway? Yeah, I would. Do I see a technical reason for that retracement on the CAD index? Yeah, I do. So would I be confident in holding an Aussie CAD long at this stage? No, I would be wanting to find a different currency that I would be more confident would be weaker over the medium term. But as soon as I do that, your observation comes front and center, Gavin, which is, whichever currency you choose, you are going to be vulnerable to the risk on, risk off tone. And given the fact that the market's very sensitive to US data right now, we're likely to see the risk barometer shift at some point this week, because it's either going to be on Powell's speech, or it's going to be on the inflation print, or it's going to be on the consumer data. So you're going to see some whipsawing price action. So for me, and for those reasons, I don't feel confident. But your logic, Gavin, is good. And if there was all of a sudden a reason for a divergence between the Aussie CAD, like a monetary policy divergence between the RBA and the Bank of Canada, that's what would get me interested in the swing trade. Now, I have to say a few disclaimers there. That's just my opinion. And I could see a case where someone else takes a legitimately different opinion to that they could rationalize. So sometimes, one person likes something, but another person doesn't, and there's nothing fundamentally wrong with it. I think your basic logic and your basically theme thinking is right, but I don't like it for the reasons that I've outlined. And also, you've got to remember my bias at the moment, and so you understand how I'm seeing things, is I'm seeing things very uncertain, so I'm looking to focus on short, sharp data point differences, or very long-term picture stuff. I'm a lot less confident in terms of where I'm seeing things going medium term, and I'm trying to keep trading those short deviations and then try to get into the medium-term picture, sort of 1 to 3 months as soon as I've got some kind of confidence in it. So that's how I'm kind of seeing it, Gavin. That's my take on that. But your whole rationale, your whole thinking process is very sound. It's the right way to be thinking. It's the right kind of thing to be doing, and it shows a more advanced understanding. So, it's like A star, and it's one of those scenarios where you have to say, well, actually, Gavin, you could be more on the money than me with that. So that's my disclaimer. But thank you very much for bringing that up, because that just enriches everyone's. Yeah, I think the picture just isn't clear, and you see the thing that skews the picture for me a little bit is the link with oil, and the outlook for oil is really uncertain. Medium term, I'm definitely bullish oil. Short term, I'm not so sure. So I really like oil longs, and by implication, I think that should be supportive for the CAD. But in the near term, I could easily see oil, drop down through that trend line. But I think it's quite a good value area to potentially buy oil at this zone. Stops, 68.50 look perfect. So I really like it from a structural point of view. I really like it in terms of the medium-term outlook for oil. Because it's quite depressed prices. Do I expect oil to be higher in 6 months' time? Yeah, I do. I expect to see oil testing that sort of 95, 100 region at some point this year. Could you manage risk there? Yes. Should that be supportive for the CAD? Yeah, it should. But then, the likelihood of oil getting supported is likely to be on risk on as well. So it's likely to be supporting the Aussie too. Okay, folks, thank you all very much. It's been an absolute pleasure. Gavin, thanks for your great questions. Really helped to add some color and flavor to it. Thanks everyone else. Don't forget, we will be back here on Wednesday, and you don't want to miss this because I will be getting us ready for the core inflation print that's coming. So Wednesday, 12:30, I'm going to show you exactly the instruments I'm trading, how I'm going about it, and we'll also have a Q&A during that session as well. Yeah, thanks to you, Gavin. Very happy New Year to you. Matteo, Maurice, Nahar, Saeed, good to have you. Kingsley, great to have you. Take care and have a very good rest of the week. Thanks everyone. Now watch out for Powell's speech tomorrow. If you're anything to do with the dollar, be careful of it. And the dollar all week this week is likely to be volatile, so get ready. Thanks everyone. Now goodbye.